The finance department is responsible for making sure the company has the required funds to operate throughout the year. It must monitor cash flow from operations and investments and make financing decisions to borrow or pay back debt. Finance's top priority is to make sure the company does not run out of cash during the year. If it does, a lender of last resort we call Big Al will show up with a check for an emergency loan. You don't want to meet Big Al because his interest rates are extremely high. A good chunk of the money you'll need to run your company will come from operations. But to be successful, a company needs to grow. You'll need to turn to the banks and markets to fund that expansion. You can raise capital through current debt, bond issues, and stock issues. Your current debt interest rate will fluctuate depending on the health of your company financials. The interest on bond issues will be marginally higher than this year's current debt rate. For example, in a standard scenario, if your current debt interest rate is 12.1%, then the bond rate will be 13.5%. Remember, when you issue bonds, the interest rate is locked in for 10 years. Brokers charge a standard 5% fee for issuing stocks and bonds. Keep in mind, the rates and fees may vary in custom scenarios. The December 31st cash projection displays how much money you will have on hand at the end of the year if everything goes according to plan. This number assumes that the sales forecast you developed in marketing is accurate. You want this number to be positive. If it's not, there's a good chance Big Al will show up, and you'll be issued an emergency loan for running out of cash. Interest rates on emergency loans are 7.5% higher than current debt interest rates. If your cash projection is negative or close to zero, it's a good idea to raise capital and or reevaluate your investments. Finance also determines your accounts receivable and accounts payable credit policies. Lengthening accounts receivable means customers have more time to pay. They'll find your products more appealing, but this will tie up cash, reflected in your December 31st cash projection. Lengthening your accounts payable policy will free up cash, but the longer you take to pay your suppliers, the slower they'll deliver materials to your production lines, which can hold up manufacturing, reflected in your production after adjustment. Higher AP policies increase labor costs because workers stand around waiting for material to arrive. You can see this reflected on production. As your company grows and becomes profitable, you can pay a stock dividend, buy back stock, or retire bonds. Brokers charge 1.5% to retire stocks and bonds. There are no brokerage fees for bonds that are allowed to mature. There is never a good reason to accumulate cash. If you have excess cash, first consider reinvesting in the business, or it can be given back to shareholders in the form of dividends or used to buy back stock and bonds. Good luck.